What's up, guys? It's Nick here from Nick's Taxes, back with another video. And today is the beginning of a new season. For us accountants, it's called tax season, our favorite time of the year. So I thought this would be a great opportunity to come out with another video explaining how taxes work. And so in this video, I'm going to talk about some things that you wish you knew and learned in high school, and that is how your taxes here work so you can understand the whole system and filing your taxes. For this video, we're just going to talk about employment income and self-employment income, as those tax rates are the same. There are some different rules for investment incomes and business income, and I can talk about that on a different video, but on a high level, investment income do have tax preferred rates. You end up paying less on some investment income compared to employment income. And with the different rules, I'm just going to talk about employment income because I know a lot of you guys watch my videos on the CERB and all of that stuff, so I know you are affected, not infected, hopefully not, by the job market. And so we're going to talk about how your employment income and your overall taxes affects whether you have a refund or a balance owing on any of your tax returns. So before I get started, just take a second here, give this video a thumbs up for the value and as payment for this information. And if you're new to the channel, please consider subscribing. I'd appreciate that a lot. Thank you so much. But let's get into the content here. So for taxes in Canada, there are two rates. There's a federal income tax rate and a provincial income tax rate. And so depending on what province you are a resident of, those taxes are going to be a little bit different, but everyone is subject to the same federal tax rates. And so for this video, we're going to talk about the federal tax rates. So all the Canadians are subject to these federal tax rates on a base level. Now, Canada has what we call a progressive tax system. It doesn't mean that they're more woke. It just means that the more income you have, the more taxes you're going to pay. You progress through these different tax brackets. So for 2020, that first tax bracket is $48,535 and less. And so if you're in that bracket, the federal income tax rate is 15%. So any income that you earn, if your taxable income at the end of the year is under $48,535, your tax rate is 15%. Now, once you get past that income and you're above $48,535 and under $97,069, your tax rate is now 20.5%. So one common misconception is that as an employee, if I say, oh, my income now just went from $48,000 to $49,000, that kind of sucks for me because now I'm paying a 20.5% tax rate compared to a 15% tax rate when I was just earning $1,000 less. That is false because the progressive tax system, how it works is you fill up the first bracket before you move on to the second bracket. So my first bracket from 0 to $48,535 is 15%. Everyone who has income in that bracket fills up that bracket. Think of it like a cup and you're pouring water into a cup. Once you get that filled up, you move over to the next cup. Okay, and that cup is from $48,535 to $97,069. So you fill up your cup with your income, you fill up that first cup, 15%, and then you move on to the second cup. And then once your income runs out, or once you don't have any water left to fill up those cups, that's where you find your marginal tax rate. So if I move from $48,000 of income to $49,000 of income, I'm not paying 20.5% on all of my income. I'm paying 20.5% on the difference between my $49,000 and my $48,535 because that difference is how much I'm pouring into that second bracket. Now, these brackets go on and on. There's 3 more after this. The next one goes from
$97,069 to $150,474. That tax bracket rate is 26%. After that goes from $150,473 to $214,368. that is a 29% tax bracket. And then any income that you earn more than $214,368 gets taxed at a 33% rate.
So each bracket has their own tax rate. And so once you fill up the first one, you move on to the second. And the Canada website actually has an example, and I can show you so that way you kind of have some sort of visual to understand how this works and how it's going to impact your taxes this year. So I'm going to share my screen here. I'm sharing my screen, and you can see here, this is part of what's formerly called Schedule 1 of the tax return. And this is where the nitty-gritty calculations and the details all come into play to figure out how much taxes you owe. You can see each bracket here from $48,535 all the way up to $214,368. You can see here the taxable income is $50,000. So they move over because it's in that second bracket between $48,535 and $97,069. $50,000 goes in there. They subtract the top of the first bracket, which is $48,535, which means that $1,465 gets taxed at that 20.5% rate, which equals $300.33. And it gets added to the amount of tax from that first bracket, which is $7,280.25. Now, if you're saying, hold on, where does that $7,280.25 come from? Well, it comes from the first tax bracket because we exhausted the first bracket. We filled up our cup. We moved on to the second one. And if you multiply 15% tax rate times $48,535, you're going to get $7,280.25. So that's the total tax from that first bracket that we filled up. And now we're adding the tax that we've calculated from that second bracket. And so that is how we calculate our taxes. So if I move on actually over to Cloud Tax, they have a Cloud Tax calculator, and they do just that for you, but in a way that's a lot more simpler for you as the user to figure out and to enter in. So once you enter in your province, Ontario, I put in my employment income, I'm going to say $50,000 just like the previous example. I can see that my calculations are being done here for me. And it says that I will owe $7,544. Now I can enter in my income tax paid. Let's say it was, $7,500. Oops, there we go. It's going to figure that out for me. And so some of you guys have been asking me questions saying, okay, now do I have to include my EI because EI already withheld 10%? And the answer is yes, you still have to include it because that's considered a taxable benefit. So you can see here, there's a section where you can put in other income and EI. So I'm going to say I made another $5,000. So that gets factored in. And now what you would do to also factor in the amount of income tax that was withheld already from that amount, you would enter that down into the income tax paid section. So 10% of 5,000, I'm going to say it's $500. So I'm going to turn this 7,500 into 8,000. Bam. And so now it has my calculation for me that I will owe. This here is factoring in the provincial and the federal tax rates. And the same thing happens when you actually file your taxes. Your tax return is essentially just a giant calculator to calculate your taxes. You're inputting in the information, and then the software is figuring out how much tax you owe based on the amount of income you're reporting and the amount of credits that you have. So before we get into this breakdown, there's also two things I want to talk about, and that is there is a non-refundable tax credit and a refundable tax credit that are available for most Canadians. The big one is the basic personal amount. And for 2020, that amount is just over $13,000. All the non-refundable tax credits, such as the basic personal amount, get factored in and then multiplied by 15%, which is the lowest federal income tax rate. So that's why if you have income that's $13,000 or less, you end up not paying any taxes, because you're in that 15% tax bracket and that basic personal amount covers all the tax. The other credit is the refundable tax credit, and that allows your taxes owed to become a negative and you could end up in a refund. Whereas non-refundable obviously will reduce your taxes down to zero, but won't end up in any sort of refund. Okay, so now with that information, we can take a look here at this example. Here's a dummy return I did through CloudTax. And also if you want to use CloudTax, you can literally download their app, and their app will walk you through everything and enter in all that information and then break this down for you. So it says here my total income was $66,075. What I did was I entered in a T4 and then I entered in some CERB amounts. And then from next section, it calculates out my net income. So if I have any deductions, such as the work from home benefit that's now available for those who had to work from home due to COVID, that would be a deduction. Here we just have a deduction for CPP. It lowered my net income to $65,843.67. This is the amount that is going to be factored in on how much tax I'm going to owe. My taxes are going to be based on this net income amount, not my total income amount. So the next section is the federal non-refundable tax credits. And again, there's that basic personal amount and a couple other non-refundable tax credits that I qualify for and that CloudTax identified by going through the whole process with me. I just answered their questions and provided that information, and it came up with those credits. And so there you can see my total non-refundable credits comes to $2,685.72. Remember, the non-refundable credits get multiplied by 15%. So you can see here, line 42000, I have a net federal tax of $8,142 and a provincial tax of $4,072.19, which gives me a total payable of $12,214. Now this is where we identify if I'm in a refund or owing position. And so that's when we look at the total income tax deducted from my T4 and other slips such as the EI in which they withheld 10% or the recovery benefit in which they withheld 10%. Often, like we've said, that 10% is not going to cover your entire tax bill. So they've added up, and they've said right here that from all the amount of tax that I've already paid the government in 2020, it was $9,074. I also had some refundable tax credits that I was entitled to, such as the climate action incentive for $300 and employment insurance overpayment. So my total credits that, for 2020 that I've paid to the government or that are included as credits is $10,806.20. So because my total payable for 2020 was $12,214, I now have a balance owing of $1,408. And that is how your taxes are calculated in Canada. Okay? Obviously, this is a very high level. I try to do this very quick in under 15 minutes. And so I've left off some things, but this is the high level, the basics. If you have a T4, if you received CERB, if you were paying employee tax, on each paycheck, that's what it's going to look like. You're going to enter in your T4. You're going to enter in how much tax you withheld from that T4. It's going to be right on the slip. You're going to file that information onto the CloudTax software, whatever software you use, box for box, and then it's going to calculate it out for you using those tax rates plus the provincial tax rates that we just looked at. And that is how we are going to be calculating your taxes for 2020. If you got value, please give it a thumbs up. And as always, please consider subscribing. I'm Nick from Nick's Taxes. Happy taxing.